Thanks everyone for joining us for our Thursday Colloquium session, our second last one for the year. And today we have Prof. Mark Swilling, who's going to be giving us a update and going through one of his recently published reports that he published alongside Dr. Stephen Moran on financing infrastructure, particularly around the monetary architecture approach. So I'm not going to take any more time, and I'm going to hand over to Mark. Thank you so much.
Okay. So mainly for the benefit of Nina, who has been pressing me for a while on what is this elasticity basis. So why don't I just tell a personal story, which illustrates this idea, which in turn triggered this whole journey, this 2 and 3 year journey. That was one very simple experience that raised a reality that I was part of that didn't fit my conceptual framework. And then I went to look for a conceptual framework that fitted this new reality I was confronted with. And I have the advantage of being involved in a bunch of stuff, so I get confronted with new realities all the time. But this one really fundamentally shifted me. And it happened when I was chair of the board of the Development Bank, something like that. And the regulator of the DBSA falls under the National Treasury, the Ministry of Finance. And so does the Land Bank, which is our oldest DFI set up in and what happened when I was chair of the board, the Land Bank collapsed. Basically, have a long story short, it couldn't meet its obligations. And when that happens to a bank, then all the people who have lent you money basically get cold feet, and they say either give me all the money back, or they say no more money, and you get cut off basically. So that's what happened to the Land Bank, and it got deeper and deeper into trouble. But what happened with the same lenders who provided the Land Bank with money, provided the DBSA with money, which are the South African capital markets. So what the South African capital markets said, listen, we can't trust the Ministry of Finance to stand behind the Land Bank. They made the wrong move. So how can we trust you, because you're regulated by the same principles? So we're going to cut off funds to you, as even though there's nothing wrong with it, but we can't trust you. Because in finance, everything is about trust. Everything. And so what happened is they cut off access to South African rands, and we had to depend more and more on euros and dollars, and convert those euros and dollars from international DFIs into South African rands, which you can imagine is not a great idea, because you pay a lot of money and there's hedging because of foreign exchange risk. And you end up actually not being able to fund the projects that were fundable before. So this was a major crisis for the bank, in particular funding poor local authorities who can't even afford to pay back even if the money's cheap. So we wrestled with this problem, and the solution was, well, if the problem is the Ministry of Finance, how do we get away from the Ministry of Finance? And the obvious answer was to fall under the South African Reserve Bank. And then we discovered that actually internationally, most DFIs fall under the South African Reserve Bank, or the central bank of that country. And so I had a meeting with the Minister of Finance, and I said, listen, we have this problem and we'd like to migrate across to the South. I remember this meeting, he looked at me like I had chicken strip on my nose, and he said, no ways, you mine. He said, you will still be the owner, but you're not the regulator. So, still yours. But okay. Eventually signed a letter. We got the same permission from the go-ahead from the central bank. And then, this is what then happened. We then went back to the South African capital markets, pension funds, insurance funds, the banks, and said, okay, this is what we're thinking of doing. And they said, oh, that's wonderful. then you're just like us, because we're regulated by the central bank, you're regulated by the central bank, the same set of rules, we can trust you. Oh, okay, that's wonderful. And they said, oh, actually, what's more, we'll be able to give you access to more funding than you had before. I said, how much more? They said, well, maybe 4 times more. So at that stage,
On what basis?
Trust. Again, you can be happy. So okay. So at that stage, the balance sheet of the TBSA was about 120 billion. So that's money that you've lent out in projects, and that could then go up to say 400 or 500 billion. I don't see the problem with that. There's plenty of cash. And it only dawned on me like a couple of months later, what's just happened here? There's no change in fiscal policy. In other words, the budget remains the same, the national budget. There's no change in monetary policy. In other words, the central bank is not printing money or doing anything else. It's just a reconfiguration of the relationships between the balance sheet of the development bank and the balance sheet of the central bank, and therefore the balance sheets of a whole bunch of South African financial institutions, and therefore less dependence on foreign balance sheets, to create 400 billion without changing policy. So it was a change in relationships between, and it's coming from CST and complexity and RICA and all that. This wasn't difficult to understand, that we'd actually shifted the relationships, and as a result, the flows of energy, or in this case, finance, changed. And then I think that this doesn't fit my understanding of how the financial system works. I'm locked into the traditional way of understanding finance. There's public finance, there's private finance. These are different rules. What's going on here? And that led me on a search, which I think must have been about a year, going through various different people talking out here, and couldn't find anyone here who could make sense of it. A couple of people internationally, and then I finally came across this guy, Stefan, who had written a very, very fascinating report on the financial architecture of the Eurozone. And what the phrase that really struck me in this report, which I had to read a couple of times to understand, was that the best way to understand a financial system, or the architecture of a financial ecosystem, to use its phrase, is as a web of interlocking balance sheets. And why is that important? It's important because in the financial system that we have today, it's what is called a credit-based system. So every rand that you have, it does not reflect an underlying material value. So if this was 1960, your rand would reflect a piece of gold. In other words, a material reality underneath. And after the Second World War, the agreement that was reached in the Bretton Woods resort in New Jersey was that all the currencies of the world would get pegged to the dollar, and the dollar would get pegged to gold. And that's why the dollar became a global currency, which was the intent. And because everybody owed money to the US because they bankrolled the war, they had the power to do that. And it, by the way, it was negotiated by a guy who turned out to be a KGB agent. So what happened in 1971, the US ran out of money to fight the Vietnam War. And they ran out of money because the amount of dollars they could print was equal to the amount of gold that was available. And they said, well, stuff this. We're just going to print money. We don't care if it's not linked to the gold. We just need the dollars. And so they snapped unilaterally. Didn't tell anybody. Richard Nixon just on television one night said, folks, the dollar is no longer connected to gold. That was the end of currency as it has been understood for centuries. And since 1971, money is simply the value you and I give to it in order to exchange. So it's perception. Hence, underneath it all is trust. And the technical term is fiat money. Money doesn't represent anything underlying value. It just represents what in the relationships we have, we agree on its value. And if that relationship breaks down and there's a breakdown of trust, the currency goes down the toilet. So if you have a crazy like that's a lot better, but when Zuma appointed that idiot as the Minister of Finance for 3 days, the weekend special, the world said, it must be insane. You know, we sell the rand. Luckily, it was just arrested, but I mean, that's what happened. It was a collapse of trust. So I came across a web of interlocking balance sheets. In a credit-based system, a financial system is a web of interlocking balance sheets. Okay, great idea, but you know, what does it mean? What does it mean in practice? And there was quite a lot of literature said, we haven't quite figured that out. It's a conceptual idea. Stefan Moreau said, I've found a methodology. I've developed it. And he applied it to the Eurozone. And I was convinced. Actually made a lot of sense. So I invited him to come to South Africa and say, let's work together. So he's not one of these European development economists who travels around the world. He only looks at his own country and Europe. And so he was quite surprised. And he came, and chemistry between us worked quite well. And we started to talk about how to do this. And GIZ gave a little bit of funding to cover his costs. And I got approval for a terms of reference from the finance task team of the National Planning Commission to do the work under the auspices of the NPC, which was important in order to get the access needed to a whole range of experts across different subsectors of the system. And so coming back to my personal story, the DBSA, SARB, capital markets, etc., that's an elasticity space. So the elasticity, and this is a key concept for Stefan Moreau. And so I never had a word for what I was part of until I came across this term. Because essentially what happened is that it was suddenly possible to imagine the possibility of stretching the balance sheet of the DBSA from 100 billion to 400 billion because of the relationships it has with a bunch of other institutions, who in turn were going to stand, the SARB balance sheet would stand behind the DBSA, so it's acting as a guarantee, so that's a relationship that allows this balance sheet to expand. And the South African capital markets would say, oh, okay, so you've got a good big giant guy behind you who's going to bail you out if things go wrong. In other words, a guarantee, therefore you can be trusted, even though you might mess up. You trust the person behind you. And so for them and the DBSA, there was an opportunity to kind of unlock a set of capital flows that were not possible before. And that's a space. And that's what conceptually is defined as an elasticity space. So it allows malleability that was not there before, just by changing the relationship. So with that story, it then became important when I got into the NPC. I was also a coordinator of the infrastructure task team. I don't want to get lost in all of this, but we analyzed how much money we need to achieve water security, how much money do we need to achieve energy security, how much money do you need for digital security, and also looked at food, which is not listed here. And all of these reports in the last couple of weeks have been completed. And so there's a gap. And the question is, what do we need in order to realize our goals? What do we actually spend? What's the gap? And can we fill that gap through identifying some elasticity spaces where, like with the DBSA, you could now change the relationships, unlock money that was not there before. in order to fill the gap, which is a completely different way of thinking to say, there's a gap, therefore we must go to the Minister of Finance to get more money. And the Minister of Finance said, well, okay, if you want me to do that, I have to increase taxes. Do you want that? I have to borrow more money, which means I'm going to be paying more interest, which means, and I'm already paying more interest than I'm spending on health and education combined. We want to make that worse. And if you say yes, then he has to make sure that he collects enough taxes in the future to cover those costs, which will only happen if you don't steal the money. So you have to think of another way. So I'm not going to dwell on this. I'm going to dwell on this picture. So this is what I've just said. There's the state, collects taxes, it gets loans from international and local lenders, it issues bonds. Most of the bonds on the bond exchange are actually issued by government. Most of them are bought by the rich people. When a government issues a bond, you buy the piece of paper, and the government says, I'll pay you back in 5 or 10 years at the following interest rate. Loans, you know what those are. Taxes, you know what those are. And then the state is then supposed to invest all of that money in infrastructures. If you do that properly, you can grow the economy. If you grow the economy, you'll be able to generate the revenues in order to pay back your bonds, to pay back your loans, and collect more taxes in order to spend. So this is how our governance in South Africa worked up until 2012. And then state capture broke down, trust gone. Once trust disappears, people lend you less money. They don't buy your bonds. If they do buy your bonds, you have to actually pay them more to buy your bonds. And that means you're pushing up the debt, which means you need more income. And if your system is collapsing because your infrastructure is not generating the growth it should, you can't collect the revenues to cover your bonds, and you just get debt. You get this piece.
Yes.
Okay.
Yeah. So that was like in a million flag.
So if you, so one solution to this problem is say, okay, let's fix the state. Right? Let's go back to this. Let's go back to this. How long is that going to take? And can we wait 3, 4, 5 years, 6, maybe longer? Because it takes a generation to build institutions. It takes 5 minutes to destroy them. So we have to have a workaround, and all of this work is actually a workaround to say, while we are fixing this, we need to think of other ways of redirecting the flows of capital. Remember the elasticity of my DBS failed. So, and to have workarounds which simultaneously rebuild state capabilities, but maybe different kinds of state capabilities, not the ones that were there before. So this is incremental. Andy, what's his name? The PDIA, whatever. It's exactly that. How do you find ways of redirecting flows of capital in ways that rebuild institutions? And I'll come back to that. So this is the monetary architecture framework, which I've already explained, so I'm not going to go through it in detail. So what we did in this report is 284 pages. We firstly provided a historical framework for understanding the evolution of the financial system through 4 snapshots. What was the state of the financial system in the mid-80s? The state of the financial system at the democratic transition, 94, 96. The state of the financial system as state capture starts to set in, but there's half the banks have disappeared by then. In 2002, there was what is called the small banking crisis, which led to the collapse of or closure of half this, and they're all making small banks, or they were swallowed by the big banks. So overnight, net banks swallowed BOE, and doubled their market share. And then in 2024, basically the current moment. So it's an exercise in history, if you like, so that people understand the historical evolution, which is completely different mindset to modeling. So the people who dominate in finance are basically modelers. So you never have history. You have all sorts of fancy diagrams and flows, and you never really know what the algorithm looks like underneath. So this is more transparent. It's qualitative. It's historical.
And it shows you how the conditions were created for
Yes.
different things to happen.
Yes, yeah, and it highlights those. So I knew quite a lot of this history, but from a governance and policy, state capture, democratization, point of view, I learned an enormous amount, realizing underneath what the financial drivers were. So, for example, in 1985 there was a debt crisis. Where basically 233 international banks, after the Rubicon speech by P.W. Botha, where he said that you're going to give up white power, 233 banks said, okay, we're not going to roll over our debt. So you owe us money, you can't pay it, but we're not going to give you more money in order to roll it over. We're going to say, pay us back. It was a massive financial crisis, but I didn't understand how it worked. I knew it had happened. I now understand how it works. Similarly, in 94, 96, I didn't really understand how the National Treasury was constructed and how that created a framework for the massive expansion of the pension funds. I never understood the connection because basically before 94, there was a couple of small numbers of savings and pension funds. Now we have the 16th biggest pool of pension funds in the world. Bigger than France, bigger than India, bigger than Spain, bigger than Chile. It's a massive concentration of capital which doesn't get reinvested. So I've understood a lot of those dynamics, and they're written out fairly simply and as plain a language as possible.
Sorry, and that was part of Stefan's methodology, or
no? This is my training applied to an understanding financial history of South Africa since the mid-80s, using the framework that he uses, which is to understand the financial system in terms of a set of different categories of financial institutions which I'll come to. So RBS, what not. So they were eventually, it was great working with Stefan because he doesn't claim to know anything about the Global South or South Africa. So I had free reign, so I could really be myself. And I wrote it all. And I'd send everything to him and it would come back full of red. And I'd rewrite it. I'd send it back to him full of red. And he's German and very serious. And there was no wriggle room or negotiation. It's very tight. But it allowed me to be myself. It was really great. And eventually, 3 issues emerged. One is inequality. Second is gross fixed capital formation, which I'll explain. And the third is the absence of a governance system that governed South Africa's financial system as a system. So we had the Ministry of Finance manages the public sector. We had all the different financial institutions that manage the private sector. But we don't have a system to say, or governance mechanism that understood this whole thing as a system. Mm-hmm. So these are the categories. So through commissioning papers from experts in these different sectors, we're able to, this is the first time you have a complete in one picture understanding of the balance sheets, in other words, the assets on the balance sheets of these financial institutions. So the South African Reserve Bank, 1.2 trillion, the National Revenue Fund, which is just the budget, 2.1 trillion, commercial banks, 6.7 trillion, non-financial corporations, which is basically your big listed companies, 12.7 trillion, that's listed shares. Small businesses, 2.5 trillion. Shadow banks, which I'll explain. These intermediaries, 3.2, and they were basically non-existent. For pension funds, 6.7 trillion. So GDP is 7 trillion, right? 7.5. So, so in perspective. The government employees pension fund, which is the biggest pension fund on the African continent, 1.6 trillion. Stokvels, state-owned enterprises, and the development finance institutions. Just a small amusing story. I presented this PowerPoint to the ANC Lakota at the beginning of the year, and then had lunch afterwards with the president, and he said, "You have a mistake in a slide." What are you talking about? It says SOEs are not 1.3 billion, they're 1.3 trillion. So he actually spotted this mistake. I was amazed. So DFIs are tiny, 0.3 trillion compared to 6.7 trillion commercial banks. These are the state-owned banks, and they're 14 of the largest ones are DBSA and IDC, but there are 14 big ones out of 45, and they make up 97%. That's 0.3 trillion. And then households are 11 trillion. That's a lot. And 90% of that is in the hands of a small fraction of the population.
The Oppenheimers.
So
And Rupert's.
So this is thanks to this kind of categorization. So what is gross fixed capital formation? It's very simple. Gross fixed capital formation is the money that goes into stuff, fixed assets. So this is a gross fixed capital formation. It's a building that is necessary for productive activities. Offices, factories, logistics, digital infrastructures, even intellectual property is part of private sector gross fixed capital formation. Public sector, that's all the stuff you know. It's energy, it's water, it's roads, it's ports, sewage treatment plants, etc. You add these two together. If you want to understand what is gross fixed capital formation, you add those two together. Your factories, etc., and your infrastructures, etc. That's gross fixed capital formation. There's no example of a country that has developed, conventional conception of development, that has developed without an increase in money going into gross fixed capital formation. If you're making profits and the money is not being reinvested, then your economy, the material infrastructure you need to make sure everybody lives a decent quality of life, that you have employment, that you have jobs, you have farms that continue to expand, etc., if you need to expand. None of that's possible if the profits made by companies does not get reinvested. And if you have governments with cash that should be going into infrastructures that's getting stolen, that's also a problem.
Does gross capital formation take into account resource use?
In what sense?
Like the resource base, like that's the infrastructures, this is the things, but like...
These are the material infrastructures that are required to extract, use, and dispose of resource flows. The resource flows are conducted through society via the material infrastructure. If you design if you want sustainable material infrastructures, then you extract less virgin material, use more recycled material, dispose less.
I'm just thinking of the logic of growth, like what you said.
Yeah.
Like,
well, the logic of growth applies in a society where 50% don't dispose of that. So if you want,
a lot gets wasted.
And a lot gets wasted. So if the majority of your society is a middle class society, you don't really need to grow at all. You just have to replace. The replacement, on average, material infrastructure is roughly 2% of what's there. That's no growth.
I'm just wondering if this formula that you're proposing is always fixed. The gross capital formation equation equals growth.
It's always fixed, but you can do gross fixed capital formation in a sustainable or an unsustainable way. So normally, the conventional development model is increased gross capital formation, decline in environment, in natural capital.
Yeah.
That's development. Strictly strong sustainability is you have increase in gross capital formation and a restoration of natural resources. What that means in practice, you have to redesign those material infrastructures. For example, you don't sell any cars, just lease them all and you take them back and you recycle them. All your water systems will change. All your sewage systems will change to recapture all the resources that you throw away. You decarbonize everything. You would build most of your buildings out of wood that you can grow sustainably. Everything would change. And then the green line starts going up over time. This is all premised on the green line going down.
Going down. Yeah, okay. That's what I just wanted to.
No, I mean that's what it is. That's what it is. So when I used this framework for Colombia, they said, no, we don't want this.
Yeah.
There's no green line. Well, if you put the green line, it's going down. They said, that's not what we want. So we invented a green concept, which in the margins of economics, there's a bit of that drawing. It's quite useful. So as you can see here, on the right-hand side, you have total gross fixed capital formation as a percentage of GDP going up, peaking in 2010, and then basically dropping like a star. And at the bottom is infrastructure. The difference between infrastructure and the blue line is private investment in infrastructure. So the dotted line is public sector investments in infrastructure, and the solid line is total. So what's in between? It's your factories, it's your et cetera, that private sector invests in. So if you like, call it productive material infrastructure and public service infrastructure. Those are the two that get basically reflected there. And then you can see the different sectors. Construction is the big driver. What's that? FIFA. And then there is your machinery and other, that's the gap. And number 3 is, it's the one that, and then there's, I think it's transport, yeah. So.
It's also interesting on the right, mostly like Toco is tracking also the pattern of the public.
Yes.
But there are places where it's not totally tracking.
Yes.
I think especially there at around 94. See, there's like quite a big spike
yeah.
there, but it's not in the bottom line.
Yeah.
Which is kind of interesting. There's obviously very extra.
There was a story.
There was a
story about South
The
Africa.
private sector did come to the party.
Yeah, so they should
driven.
They should driven. It's like
And municipalities were, the metros were still okay.
Yeah.
So just compare this to the rest of the world. We're third from the bottom in terms of upper middle income countries, unique upper middle income countries. For the period 2013 to 22, which is the red, and then 23 to 28 is the hash. And you can see we're just above Equatorial Guinea in terms of investment in gross fixed capital formation as a percentage of GDP. So there are countries like Malaysia investing more than us, Bulgaria, Serbia, Belize, Namibia. Oil infrastructures. Senegal last year was the third fastest growing economy in the world, off massive gas and oil.
But that's also the thing.
So I just want to show you the picture on So this is the first time household wealth has been incorporated into this kind of analysis. So Stefan Moreau doesn't do any of this in his work. So why is it possible to do in South Africa? Well, it's because our former dean and various other researchers here and at UCT have pioneered a reinvention of the definition of wealth in South Africa. So in the 90s, the only data we had was income data, Gini coefficient, difference between what people earn. As a result of recent research, it is possible to, they've worked out methods to analyze the wealth of households, all households, the liabilities on household balance sheets, and the assets. If your liabilities are more than your assets, you're getting poorer, basically. So because we have this household balance,
Come on, people.
so we were able to use this data, which was incredible, and Stefan was very surprised that it was there, and it's very solid, and it's been synthesized by these guys, Chatterjee and others, for UNU wider. And the key point is that 0.1%, so this is the piece over here, you can see their share of the wealth is 29.8%. And you can see that the bottom 90%, their share of the wealth is 14.4%. Are you with me? And this is shocking stuff to absorb. Yeah. What that means is the 0.1%, their wealth, it's roughly 35,400 households. Their wealth is equal to twice the bottom 90%. So their pensions, their savings, their holiday houses, their mansions in Johannesburg, their savings in their offshore trust accounts, all of that added together is equal to twice the wealth of the average South African, the bottom 90%. Are you absorbing this? Are you getting this?
Slowly.
Eh? You can see what the average purchasing power parity, $15 million of those households. Versus 15,000 on average dollars. That's you. So, okay. So I think you get this, right? So the good news, though, is the rich get taxed. So 10% of the population pay 72% tax.
86%. Wow.
Yes.
Yeah.
And the other piece of good news is 60% of state expenditure actually does benefit them. So we have got kind of left of center, semi-welfarist kind of government that does allocate a hell of a lot to the poor. So the poor, there has been some advance, not nearly enough. 10% of the chronic poor, that's 50% of all households, have transitioned out of poverty, only 10%, and that's mainly from social growth. 40% of the transient poor, which is roughly 10% of the houses, of the households, have moved out of poverty. Social grant, subsidies, microcredit. Middle class is deracialized, maintained its living standards though through massive increases in consumer debt, credit cards, Trueworths accounts, Ackerman's accounts, right? But it's middle class. It's against their incomes. Yeah. And the elite, well, increased the most. So in other words, the rich got better off than the rest. Mainly pensions and bonds. And what are bonds? I told you what the bonds are. These are government pieces of paper. So a lot of the wealth of the elite is actually sitting in pieces of paper that they bought from the government to fund the government. And they sit in Seapoint and they collect the interest on that.
Which is their elasticity.
It's their elasticity space. Yeah. So this is what the budget the budget compared to GDP looks like since the mid-90s. So you can see we had a really good run all the way through to 2010, where we were increasing spending and growth rates were pretty impressive. So that's on the left, those bars is the percentage increase over the previous year. So it was increasing quite rapidly. But then from 2008 is the financial crisis, which was the big blow, and then soon after state capture. And the combination, the double whammy of state capture and global financial crisis, basically, we've never really recovered. Just spending keeps going down, which is mainly on the poor. And we've never really come out of growth. I've been invited to present some of this tonight at a dinner hosted by the Minister of Planning in the presidency. And the keynote speech is the Minister of Finance, who's going to wax lyrical about his budget and how there's a budget surplus, and this is preparing the way for growth. And Lynn Ramahopa, the Minister of Planning, wants me to kind of say, well, maybe not. So
sorry,
yeah.
can you just go back to 2020, is that COVID impacts? And
yes,
then 2021 is stimulus package.
Yeah, obviously, I mean, if you're going negative and the next day you're going positive, the percentage increase is impressive.
Yeah.
You know, off a very low base, and in fact, a negative base.
So we had elasticity. We just didn't use it.
Yeah, well,
What? What?
there's lots of elasticity spaces available which we're not exploiting. So that's the key. So I can't too slow.
There's a big story there.
Yeah. I want to just bring into focus what people don't think of. So you might have seen Adrian Enthoven published an article which was we're turning the economy around. This is not what he discussed. Because he sent it to me, he said, "These are right critique. This is what I'm going to present." What you can see on the left-hand side is what I've already explained, right? This is what companies, broken up into sectors, communication, construction, contributes to gross fixed capital formation. So you can see in terms of the average growth of gross fixed capital formation per annum during the period 94 to 20. Communications, this is Vodacom, MTN, is growing fast. And they're putting up towers, and they're building offices, and they're putting in infrastructures, 11.5%, not surprising, right? Go down to manufacturing, diversified manufacturing at the bottom. These are the factories that are supposed to employ armies of blue-collar workers. What's their contribution to gross fixed capital formation? 1.9%. You follow that? That means they're not putting as much money into expanding their factories. In fact, they're closing them down. And you can see the other transport is pretty high. Electricity and gas is fairly high, but finance and insurance is not high. But we know that it's a big part of the economy. Why? Because you don't need a lot of stuff to run a finance company. You need a couple of big offices. But you're not building factories, you're not building big roads and infrastructures, or whatever. But the most important point is the second column, average net markup. That's just fancy economics language for profits. Okay? So look at the most profitable sectors. Yes, communications is very profitable, 42%. And they're reinvesting. But look at the other ones. Look at wholesale and retail. 41% profit margins, fairly low reinvestment in infrastructure. Look at finance, how profitable it is. Very low levels of investment in infrastructure. Look at who's shedding jobs. Mining and quarrying, shedding jobs. Profit levels very high, but they're not investing in expanding their mines. So what this is telling you on the whole, in summary, is the story here. This is a picture done by some people at UJ, which shows, so what I did is I took the orange and the blue out, which is for banks and insurance, finance. Because I'm not interested in these finance and insurance. Take them out, and what's left is on the right-hand column. This is all the other sectors. If you work out how much they are investing, what portion of their profits are they reinvesting, it's roughly 10%. 10% equals replacement of what you have. It's not expansion. The target set in the National Development Plan is 30%, is what we should be investing as a percentage of GDP. Countries that are developing, and yes, the green line is going down, is between 20 and 30%. So to shift away from this is listed companies, right? This is the top list 50 listed companies.
There's corruption and capital flight. Are they factored in?
It's not reflected.
Anyway,
no. I mean okay, let's put it this way. If you're making high levels of profits, let's say wholesale and retail, 40%, and you're reinvesting even less than 10%, right? Where's the rest of it going?
Yeah, that's why I'm saying that. Why isn't it accounted?
The rest of that is being invested in the financial system. And the financial system is highly it's highly speculative. But the definition, but if you are investing, you're investing. If you're buying money to make money, you're not creating any value. But you are adding to GDP because in the 1980s GDP was changed globally to include finance. So you're making money out of money, and the only way you can continue to make money out of money when everybody's trying to make money out of money is to make sure that the number of transactions keeps on speeding up. It's called the velocity of money in an economy. So if the velocity of money is accelerating in an economy, all the people who are making fees out of moving money into this deal, into that deal, into this deal, into this deal, without creating any value, are making fees to pay off their Ferraris.
Yeah.
But it only works for as long as the Ponzi scheme continues to get faster and faster and faster, and then at a certain point, it just bursts. And you have a crash. That's how the financial system works. And there are people who make bets on the fact that it's going to crash. So you probably saw The Big Short. Okay. That guy has just bet against AI.
Oh, no, really?
So the biggest, richest company in the world is NVIDIA, right? Everybody's betting that it's going to get more and more profitable. Yesterday he placed a bet to say it's going to crash. Same guy. So you can make money by anticipating the velocity is going to slow down. That's The Big Short. So it's a crazy system. It's completely insane, irrational, evil system. It's all abstract, and it's all based on relationships and trust, actually. You do my money, you pay me back. I'll lend you money, you invested in him, even though it's my money. And he pays you back and you have to pay me back. But if you bet on him losing, you still win and I lose.
That's being informed.
So to change the lens completely, this is the small business sector. So this is the big aha moment of this whole exercise for me. There are 700,000 small formal businesses, 1.7 informals, spaza shops, and so on and so forth. The small business sector creates more jobs than the big business sector. And it contributes a greater added value than the big business sector. I was really surprised by that. I think the reason why this conversation hasn't been part of the South African narrative is that in the 90s, those 700,000 businesses were mainly white family businesses. That's changed. 60-70% are now black. And so you can bring this narrative in powerfully. And all the surveys show that all of these businesses, the informals and the formals, complain they don't have access to finance. to expand. So they create more jobs, they have more added value, but the banks don't lend them money. And just put that together. Instead, a lot of money goes into the big listed companies. Some of those listed companies access capital here, but they invest elsewhere. There are some listed companies that don't have any operations in South Africa.
Sure.
And if you add together tobacco, British American Tobacco, and what used to be SAB, yeah, that's 25% of the shares in the stock exchange. Beer and alcohol. I mean, alcohol, beer and cigarettes.
But more business and also funds.
Sorry? Yes.
Oh, okay.
About 30,000.
Maybe just a kind of question. I don't know if it makes sense, but what does the taxing situation look like between the bigger companies and the smaller ones? Because if the smaller ones provide more value to the economy, and then they have less access to credit or to investment funds, but the bigger ones have, maybe taxing may be the tool to try to regulate that. That's something.
The problem is the big companies have ways of moving money around so that they minimize tax. So you can't rely on that instrument. So anyway, I've told you this. What I didn't mention is the Johannesburg Stock Exchange is one of the most profitable stock exchanges in the world, second only to Hong Kong. So overall, profit levels are high, and the stock exchange is very valuable. South African banks have consistently been some of the most profitable banks in the world. They're very regulated and they don't take a lot of risk. 95% of all stocks and bonds are in the hands of 1% of the population. So, in short, you get the picture. Money circulates in the wrong way. Now, who manages this money? So this is a picture from a PhD done at Stellenbosch at the business school, which shows the relationships between the banking sector, which you understand, pension and retirement funds, which you understand, you probably have some money invested there, insurance funds, and then the shadow banking. What are shadow banks? So before I get there, this is the growth in pension funds since the 90s. So middle class South Africans took their money out of banks, liquid, they insecure, so they wanted more and more money in liquid form, not locked up in fixed investments, and that's what has happened to our pension industry. The Association of Savings and Investments South Africa, which organizes the institutional investors, this is their picture. They get their money from unit trusts, from life insurance, from retirement savings, and they put it in banks, in government bonds, in various fixed interest investments, equities, and only a little bit in property. So who manages all of these boxes on the right-hand side? This is the key question. So this is no longer talking to that, but there we go. So these are these weird things. These are the intermediaries. These are the shadow banks. Money market funds, fixed income funds, multi-asset funds, and fund of funds. This is the network. They're very integrated with the banks, but the reason why they've expanded is that they can take risks that the banks are not allowed to take. So banks are highly regulated. To escape this regulation, banks move money into these shadow banks.
Give us a name so I can name it.
Owen Gray. Owen Gray will be a company that will say, okay, don't put your money in the banks. Don't put your money into fixed, because if you need it quickly, you won't be able to get it out. But you can do that long term in Owen Gray as well.
Recovery.
Yeah, Discovery Bank.
Even ABSA.
Yeah. So quite a few banks have got their wholly owned shadow banks.
Exactly.
And then there are independent shadow banks that are really these incredibly agile whiz kids who sit in Camps Bay in coffee shops on laptops and move money around to pay off the mansion up the hill and the Ferrari standing outside. And the asset managers, these guys live in Cape Town. The bankers live in Joburg.
So these are the ones that keep the velocity going.
These are the velocity makers. These are the people, their job, and if you speak to them, they're very explicit about it, is to increase the velocity and to anticipate the crash, because they're bet against the crash. So their fees used to be capped in the late 90s, that they lobbied to get rid of the cap. So now they can charge anything. And that incentivized reducing, that incentivized having lots and lots and lots of deals that are short-term. And lots of short-term deals means you don't go to the Northern Cape to invest in a solar plant. It takes too long, you get your boots dirty, and you only see your money in 15 minutes. That's not what they made of. So they have to move money around, and they're incentivized to do that. Now this thing grows. The yellow, because the money in the gray and the orange is not getting invested in real things. Only 10% of that 50%, this is 50% of the orange. 50% of that of our wealth, only 10% of that goes into the real economy, and even less into infrastructure. So where does it go? 45% leaves the country. The rest moves around through the shadow banks.
Science.
So this is how it works. I've run out of time, but the decline. This is the public sector, the SOEs. You can see that the dotted line, which is the net cash flow after interest, debt service, and capex, is below. It's underwater.
It's underwater.
It's underwater. You can see the blue is debt, the red is capex, the light gray is interest payments, and those are huge. And there's the net cash flow from operations doesn't cover what's underneath the water. Should be the other way around.
Yes.
And that's reflected in the fact that since 2014, essentially, public corporations, the capital spending by public corporations, that line of dots, has collapsed. Municipalities took a little longer to collapse, but basically that's the picture. And then this results in this, what is called the incremental capital output ratio. In other words, how much bang do you get for your buck? In other words, how much GDP growth do you get this year based on your investment last year? The less growth you have this year from the same amount of investment last year, the worse you're in. So in the 80s, when we were building a lot of electrical infrastructure, the ratio is very low. Why? Because you're putting in lots of money into very productive infrastructure that boosts GDP before it. So this is the big monster that the minister is probably going to talk about tonight, which is when your 10-year bond, in other words, the interest that you are paying people to buy your paper is going up, and your GDP growth is going down. Then there's a big jaw, big hippopotamus jaw that opens up when you get swallowed. That's unsustainable debt. If your GDP is going up similar to your bond rate, then you know you more or less can cover your debt. This is not where you're in. And the result is banks are increasing, lending government more money, they're lending the private sector less money, which means that there isn't demand for funding in the private sector because they're not growing, they don't have the deals, etc. And government is running out of money. So yeah, this is all the carbon stuff, etc. So I just want to end off here and say, right, I showed you the first picture. We have 14 recommendations at the end of the report. I'm not going to go through them, but they essentially say this. Yes, taxes will continue. Yes, loans will also continue. Bonds will also continue. You have to build infrastructure because without that, you don't have the necessary growth. If you want to put in a green line there to go up, then it must be green infrastructures, green industrialization. So the result is that you have to figure out how more of the loans side can go directly into infrastructures, which is going to have to go into those infrastructures through the private sector, through blended finance institutions like the Infrastructure Fund that I helped set up when I was at DBSA, and various other new creative institutional mechanisms that are emerging, and even community structures. Loans and bonds will continue, but less. And what you have to figure out is this relationship between state institutions and non-state institutions that can take delivery of an increasing quantity of loans from international and local funders as well as bonds to fund infrastructures in order to give rise to a different circulation. So going back to my DBSA story, it's a perfect case in point. It was a reconfiguration of the balance sheet that resulted in more loan and bond finance going into a development finance institution rather than into government in order to fund infrastructure to stimulate growth.
Does that solve the distribution problem?
It depends on how you do it.
Because what's happening here is that you're building resilience within the financial system, but do you touch justice?
So to answer the question the other way around, you can't address inequality in a collapsing economy.
Yeah.
So you have to think about how you get financial corporation, non-financial corporations to invest more profits in expansion. You have to make sure that the funding you need for infrastructures is sourced in some way, even though you can't do it in a conventional way. And then you have to ask the question, how does this get done? And in order to answer the how question, you will deal with the green question, say the type of infrastructures, and secondly, is involved. So if you're going to ask the big corporations to do the bulk of the work, they're not going to create any jobs. They'll be nothing. If you're going to say, right, let's focus on the 700,000 formal sector, formal small businesses as the real potential to, they create more jobs, they create more added value, they're more agile, and the contracting and institutional mechanisms are more complex, that is going to have the biggest impact on jobs in particular, but it also creates entrepreneurial opportunities and connects to the education system. So I don't have time to, but basically it's in the how. The green is in the how, and the justice is in the so. But you can't argue against the need to redirect the flow of capital, especially while we are trying to build new institutional mechanisms, governance mechanisms.
And you also change the role of the state, or what you think the state should be doing.
You have to, because you can't trust it to do what it's supposed to do.
We'll have to have a part two sometime. I'm more on the way forward. It seems like that's when you're really engaging now. Like, what does this all mean, and what should we do differently and build differently and restructure? Really exciting stuff. Really good work.
Yeah, amazing.
Thanks for sharing.
Yeah, I mean it's the the impact on people is the finance system creates such depression, such closure. There's not enough money. That's it. There's no abundance. There's no. So quite often, when I'm in those kinds of audiences, I do what Stephen Smith does, and he's from CST. He always starts his talk by saying, "Listen, I just want to say, contrary to what everyone has said in the room, there's plenty of money." So he starts off at abundance. And then says, and then troubles that and says, okay, now therefore let's rethink this.
I'm sure the PhDs would rather talk about that than now.
Thanks.
Does it, do you follow? Does it?
Thank you.
Try to tell it in a different way.
Now my brain is like.
It makes a lot of sense. Yeah, I just see a lot of work also as towards the justice and the green aspect. Because if we lose sight of that, then the financial people will take the new route and then do what they want to do again. And then sometime in the future, we may try to find out, okay, what is now wrong again.
So just to give one example of the justice issue. So I championed the ITP program, which is the Independent Transmission Program, bringing the private sector into building transmission assets. And it was a big battle. I was the only person on the board to support this. Eventually, we won the battle, right? Then the ministry issues a request for qualifications document, which leaves out all South African companies who built the biggest grid in Africa. So that's a perfect example where you can now invest in green industrialization, because that's why you have to expand the grid to put renewables on. But you screw all the South African companies that employ all the South Africans in building the grid.
Why?
They say South African companies don't have the experience.
The experience.
The experience. That's
And it
actual work.
And it's built into the forms, what's it,
Yeah.
public finance and forms, like your criteria by which you will be considered for procurement.
Sure.
And this
This
morning I was in that battle. I actually lost my cool, and I wrote a blistering op-ed, like calling this rent-seeking and preparing the ground for state capture 2.
Yeah.
And I sent it to the chair of the board. Who's here?
I see.
But anyway,
Also,
25 euros.
Yes,